So you've probably heard of Ray Dalio, the guy who founded the biggest hedge fund on the planet. But honestly, the story of his success isn't the most interesting part. The real story is about a failure so massive it nearly destroyed him, but in the process, forged one of the greatest investing minds of our time. And this right here, this simple idea, is everything. It's the key to unlocking how Ray Dalio thinks about markets, business, and, well, life itself. And as you're about to see, he learned this lesson in the most painful, brutal way possible. So let's back up. Who was this guy before everything came crashing down? Well, he wasn't some Wall Street insider born into money, not at all. He was a curious, middle-class kid from Queens whose dad was a jazz musician. He wasn't some academic genius, but he was fiercely independent and had a real spark for the markets early on. And that spark really caught fire when he was just 12 years old. Get this, he's caddying at a golf course, overhears some tips from the Wall Street guys he's carrying clubs for, and puts his earnings into a company called Northeast Airlines. Pretty soon, it gets acquired, and just like that, he tripled his money. That experience pretty much set the course for the rest of his life. That early success just fueled his obsession. He went on to get an MBA from Harvard, and then, in 1975, he starts Bridgewater Associates, literally out of his two-bedroom apartment. But it wasn't the hedge fund behemoth we know today. Back then, it was more of an advisory shop, helping corporations navigate things like currency and interest rate risk. But this is the moment in the story where everything changes. All that early success built up an incredible amount of confidence. You could even say overconfidence. And that feeling of being invincible led him right to the edge of a cliff. So, in the early 1980s, Dalio becomes absolutely convinced that a global depression is coming. And he wasn't quiet about it. He was shouting it from the rooftops, testifying before Congress, telling all his clients. He bet the entire farm on it. The problem? He was spectacularly wrong. The market didn't collapse. Instead, it launched into one of the biggest bull runs in history. And his firm got completely annihilated. And I really want you to understand the scale of this failure. This wasn't just a bad trade. It was so catastrophic he had to fire every single one of his employees. It was just him left. He was so broke he had to borrow $4,000 from his dad just to pay his family's bills. He'd hit absolute rock bottom. And this is where that pain plus reflection idea really comes to life. The pure humiliation of being so publicly and so painfully wrong forced Dalio to completely abandon his ego. He realized he couldn't just trust his gut anymore. He needed a whole new approach, one based not on what he thought would happen, but on a system, a set of rules for how things actually work. This led to his big epiphany. He started seeing the economy not as some chaotic, unpredictable monster, but as a machine. Sure, a really complex one, but a machine nonetheless. It has parts that interact in logical, cause-and-effect ways that have repeated over and over again throughout history. And his big idea was, if you can understand how the machine is built, you have a much better shot at understanding what it's going to do next. So what drives this machine? Well, according to Dalio, it's basically three big forces. First, there's the slow, steady upward trend of productivity growth over time. But the things we really feel, the booms and the busts, are caused by two other powerful forces layered on top: the short-term debt cycle and the long-term debt cycle. And knowing the difference here is so important. The short-term cycles are the typical recessions and recoveries we see every few years. But the long-term cycles, those are the big ones. They play out over 50, even 100 years. They end when the total amount of debt in the system just gets too big compared to income, and you have a huge reset. Think 1929 or 2008. For Dalio, knowing where we are in both of these cycles is just about everything. So how do you turn this economy as a machine idea into an actual way to invest? It's simple, really. If you believe the economy follows predictable patterns, then you can build a set of rules to invest by. And you know what the most important job of those rules is? To remove the single biggest danger to any investor: their own emotions. This really gets to the core lesson from his epic failure. Being confident is worthless. In fact, it's downright dangerous if you don't have the facts to back it up. He learned that gut feelings, predictions, ego, all of it is totally unreliable. The only thing you can really trust is a system built on data, on history, and a clear-eyed view of the probability. And that leads to the fundamental question that his entire career has been focused on answering ever since that collapse. If you accept that you can't reliably predict the future, how in the world do you build a portfolio that can survive, and maybe even do well, no matter what the future throws at you.
His answer was to break the future down into 4 simple buckets or seasons. Look, either economic growth is rising or it's falling. At the same time, inflation is either rising or it's falling. That's pretty much it. A booming economy is different than a recession, and both of those feel different when prices are stable versus when they're soaring. So he figured any good portfolio has to be ready for all 4 of those scenarios.
And this is his solution, the famous all-weather portfolio. It's a specific mix of different assets. You've got stocks that do well in good times, bonds that do well in bad times, and things like commodities and gold for when inflation rears its head. The whole idea isn't to hit a home run in any single environment. It's to make sure that when one part of your portfolio is getting crushed, another part is probably doing just fine. He calls it the holy grail of investing, achieving true diversification. So, what does all this mean for the rest of us? We can take this incredible story and all these complex ideas and really just boil them down into a few clear, powerful lessons that anyone can use. First, real diversification isn't just owning a bunch of different stocks. It's owning different types of assets that zig when others zag. Second, make rules for yourself. It's the best way to stop fear and greed from wrecking your decisions. Third, focus more on not losing than on trying to make a killing. Risk management always comes first. And finally, and this is the big one, embrace his core message. Every single failure is a gift, an opportunity to reflect, learn, and come back strong. And that really leaves us with one final, crucial question that Dalio's entire philosophy asks of every single one of us. When it comes to your own money, your own life, are you trying to predict the future, or are you preparing for it?